when I look at the markets right now and I see all this crazy volatility, and you had a market that really, really sold off today. I mean, look, interestingly, I bought a couple of things. I bought some gold because it actually went up today. That I sort of broke my rule. I usually buy it when it goes down, but I understand there are a lot of concerns, and we'll talk about that, and it's driving some of the gold prices. Now at gain of 3.6% today, but I also went in and I bought some more on the NASDAQ when it was down more than 4%. It actually closed down the day down 3%, S&P 500 down more than 2%, 2.25%. And then you had the Dow almost down 2%. There is a lot of volatility right now. I mean, I think that the trading houses, they must be making money on their spreads, right? Because they're very busy. There's a lot of activity going on. You have a lot of volatility. But today, a lot of this downside was being driven by what the Federal Reserve had to say. And, look, I'll also just point out, it's not just the Federal Reserve, it's also what's going on vis-a-vis NVIDIA and it not being able to sell to China, et cetera, and just concerns about tariffs in general, which have been driving gold prices higher and higher. I mean, 3.6% gain on gold today, and you have many analysts coming out and predicting even higher levels. In fact, I looked at the Goldman Sachs report. They're forecasting $4,000 on gold by next spring, and you have UBS looking at $3,500 by year end. I got to tell you, if you see many more days like this, like today, you could be at $3,500 long before that. Now, I'm not, look, I don't have a crystal ball, but I do sort of get which way the wind blows, and I think that there are a lot of fundamental reasons why people are migrating to gold. One could just be the reality that the US dollar is going to be depreciated in this environment. So then if gold is priced in dollars, right, you're going to need more dollars to buy the gold. So it's being used as a hedge on currency. I have a trip coming up this summer to Ireland. And so I actually am hedging the euro because I'm like, well, I thought the trip was going to be 1-to-1, and it could be 1-to-1.5 or 1.6 when it's all said and done. I've got the euro going up on me. And look, it's not entirely bad if our currency gets deflated a little bit in the near term, with the reality being we will be able to offset some of those tariffs and sell more things overseas if we have a depreciated dollar. So, there's kind of like a yin-yang to all this stuff. And I get that it's complicated, which is why I encourage you to go look at this is mine. This is my baby. I started it with my dear friend, Rob Horton, who's actually in Japan right now as we are negotiating. He's not doing the negotiations, but he is talking to a lot of fund managers over there and getting a lay of the land. He's in Japan as we speak. They are one of our very biggest trading partners. They're one of the very biggest purchasers of U.S. treasuries. So Japan is important in all of this. But again, today we got first news that NVIDIA cannot sell their chips in China. And part of that is retaliation. Part of it may be, we want to make sure that we own that AI future, and we don't want whatever China's going to do to take that away from us. And so this created a little bit of a headwind, if you would, this morning. And then you had Powell out there kind of saying, one, that, he really wouldn't be doing anything. There would be no Fed coming to the rescue. Now, maybe he has to say that, because let's face it, the Fed always comes to the rescue. It's one of those things that, back in March 2020, I'm like, okay, I realize you're all going crazy. Market's off 2,000 points, but let's be realistic here. The Fed is probably going to swoop in and print money, because the Fed loves to print money. Now they get Donald Trump in there, and they may be annoyed with Donald Trump, and they may say, Trump, he created this mess, so we're going to let him live with it. Well, you don't want to do that, right, if you're Powell, because then you will go down in history as just being kind of petty. And if he's a petty person, then he would not do the right thing for the economy because of Donald Trump. Let's hope he's not a petty person, because I think history will judge him very poorly. But he's sort of saying, look, we're so independent. We're not going to be muscled by the president or even Scott Bessent, who's basically making a list as we speak of the replacements for Powell for when his term is up. Here he is speaking at the Chicago Economic Board today. Club.
Let me turn to Fed independence. You've reiterated that you intend to stay in office until the end of your term, and that certainly reassured many in financial markets. What are the levers the government or the legislature have to pressure the Fed? And should one worry about threats to the Fed's independence once you're gone?
So our independence is a matter of law. Congress has, in our statute, we're not removable except for cause. We serve very long terms, seemingly endless terms. So we're protected in the law. So, Congress could change that law, but I don't think there's any danger of that. Fed independence has pretty broad support across both political parties and in both sides of the Hill. So I think that's not a problem. There's a Supreme Court case people will have read, probably in today's Journal, at which the Supreme Court may decide whether independent agencies generally, whether their authorizing laws can contain a provision that prevents the president from firing members of a commission other than for cause. And that's a case that people are talking about a lot. I don't think that decision will apply to the Fed, but I don't know. But it's a situation that we're monitoring carefully. Generally speaking, Fed independence is very widely understood and supported in Washington, in Congress where it really matters. And the point is, we can make our decisions, and we will only make our decisions based on our best thinking, based on our best analysis of the data about what is the way to achieve our dual mandate goals as we can to best serve the American people. That's the only thing we're ever going to do. We're never going to be influenced by any political pressure. People can say whatever they want. That's fine. That's not a problem. But we will do what we do strictly without consideration of political or any other extraneous factors.
Okay, big applause. So the other big thing that he said, and take that however you want in terms of independence. Maybe that's good. Maybe he's telling you he's totally apolitical, and when push comes to shove, if the Fed has to jump in, he would. But there was something else that was said, and it said whether or not, the question was, could the central bank find itself in a dilemma between controlling inflation and supporting economic growth? And he said, and I quote, "If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close." So again, he's like data dependent. And the data, by the way, shows that inflation has been coming down. It's just that it's not really real-time data enough. I've actually looked at some real-time data that does suggest some weakening in the economy vis-a-vis, believe it or not, Las Vegas bookings. Like, you look at the real-time data in Las Vegas bookings, it tells you a lot. And those started to soften actually in March, before we got into Liberation Day, tariffs, etc. There are some people that also believe, Ray Dalio has come out and talked about this at Bridgewater Associates, that there are sort of structural reasons that you are probably going to see some downside in the markets because things had gotten so frothy and so heady. I mean, look, I love the AI revolution. I think there's a ton of opportunity there, and it's going to create economies of scale that will be very beneficial in the future. But what happens in the near term, right? I think that's where you got to sort of hedge it out and play it out. And it's one of the reasons why we recommend gold in our model portfolios at 76 Research. It's the reason why we've been saying all along, look at gold. By the way, we said look at Bitcoin too, because Bitcoin has actually stabilized throughout all of this, which is rather interesting and amazing. But what we kind of predicted might happen. If you're interested in investing in gold, which I encourage you to do, my friends over at American Hartford Gold, one of the sponsors here on the show, we're fully independent, but we need those sponsors, right? We love our sponsors. And so I encourage you to take a look at American Hartford Gold. Go to, I'm going to give you the handle, trishlovesgold.com. So you cannot forget that, right? It's pretty easy to remember. trishlovesgold.com. I'm actually going to put it up on the screen. And these guys will really help you. They'll really help you just try and figure out what you want to be doing in this environment. Because I know it's tricky, et cetera. But let me just put that right there. TrishLovesGold.com. The best part about this, guys, is you get up to $15,000 in free silver with qualifying offers. So just a great, I was really happy about that I've always loved gold, by the way. Like I've been talking about gold forever, like long before I ever had a sponsor for gold. So this is just kind of fortuitous. But the great thing about these guys is that you get up to $15,000 in free silver. So that's a total plus, right? So check them out. They'll really help you think through all of this right now, and I get it. There's a lot to think through. I want to go back to Powell for a moment because he also spoke there in Chicago on debt, and he said something that kind of surprised me. Basically, he's sort of like shuffling it off. He's like, like we can handle it, that it's not too crazy. I mean, I kind of beg to differ. I think we have a lot of debt, and I'd like to see that decline. But anyway, here's Jerome.
You mentioned amongst the issues you were focused on was the U.S. fiscal situation. Well, clearly, U.S. sovereign debt continues to rise. And what are your thoughts on the longer-term implications for interest rates and economic stability? How much further can we go in terms of national debt before we cross a line that might be unsustainable in the long term?
So the U.S. federal debt is on an unsustainable path. It's not at an unsustainable level, and no one really knows how much further we can go. Other countries over time have gone much farther, but we're now, we're running very large deficits at full employment. And this is a situation that we very much need to address. Sooner or later we'll have to, and sooner is better than later. In terms of, if I can say from my time working on these issues, it's not the Fed's issue, but if you look at a pie chart of federal spending, the biggest parts and the parts that are growing are Medicare, Medicaid, Social Security, and now interest payments. And so that's really where the work has to be done. And those are issues that can only be touched on a bipartisan basis. Neither party can figure out what to do without both parties being at the table. So that's critical. All of domestic discretionary spending, which is essentially where 100% of the conversation is small as a percentage of federal spending and is declining it's already declining as a percentage of federal spending. So when people are focusing on cutting domestic spending, they're not actually working on the problem. Domestic discretionary spending is already going down. I like to make that point because so much of the dialogue that the politicians offer is about domestic discretionary spending, which is not the issue.
Not the issue. So that's sort of surprising because as I understood it, consumer spending was like 66% of the economy. But who am I to argue with Powell? Except for the fact that I was completely right and he way overprinted, and I was pounding the table saying this is absolutely insane in August of 2020, saying, oh, for goodness sakes, guys, you can't have both fiscal and monetary stimulus. You're going to have massive inflation. Now, who was right? Yours truly. Just saying. Okay, so Powell, before you completely dismiss domestic spending, I'm just going to tell you it's like 66% of the overall economy. We need domestic spending. We need the U.S. consumer to be vibrant and healthy and well. So the other thing that he said that kind of just sort of caused everyone to think twice, if you would, was basically that he's not giving you any sense of like what they're going to do at the next meeting. I think it's like May 7th. I would not be surprised. I'm just going to throw this out there. I would not be surprised, and this might be the only point in time where I actually think that they're doing the right thing by cutting. Like, I'd love to see 25 basis points. I really would. And normally, you know me, I'm like, don't cut, because you don't want to run the risk of inflation. But these guys are always a day late and a dollar short. They always try and make up things after the fact. And in this particular case, you might want to be looking at things like, oh, I don't know, those Vegas bookings that I've been tracking, right? And they've been declining since late March, suggesting that you are looking at some headwinds. Now, again, as an investor, like, you got to think about this in two spaces. You've got to think about, can I get some value? Can I get some bargains? I should probably keep dollar cost averaging in because, you know what, we're not going to be hanging out in the doldrums forever. I wouldn't bet against the U.S. long term, but you also might want to be thinking about, hey, you know, how do I hedge this, et cetera? And so that's when cash is king, that's when treasuries matter, and that's when gold, of course, comes into play. And I'm just blown away by the 3.6% increase in gold. Again, book club last night. You know, when the moms are getting together and all of a sudden gold comes up, that should, maybe that tells us it's a top. It was up 3.6% today. I'm just amazed. I'm absolutely amazed. But here's the thing. We don't really know where all this trade is heading, other than hopefully we'll start to get some better deals. Here's Scott Bessent, our Treasury Secretary, talking about the need for those better deals and how he is now involved, which, by the way, is a good thing. Because he's very smart, he's very sophisticated. I mean, heck, the guy broke the Bank of England. Did he not with Druckenmiller back in the day? Like, he gets this stuff. So you want somebody who's really, really smart, kind of manning the ship, so to speak. Here we go.
So less than 2 weeks ago, you and I were talking outside of the White House after what the president called Liberation Day. And you said you weren't part of the negotiations. Now you're leading them. What's changed in these past 12 days?
No. What I said was I didn't construct the actual
tariff rates.
The tariff rates. I've always been part of the tariff policy. I had been focusing on tax. Maybe you want to talk about that later. That's going very well. And now with the trade negotiations, I'm going to be part of that. And the president has hit a 90-day pause button, and we are moving quickly with many of our most important trading partners. So we had Vietnam in last week. We had Japanese in on Wednesday, South Korea next week. So it's going to move fast. And but the important thing for your viewers to know is we're setting up a process, and we are going to run that process. It's going to be orderly. And at the end of the day, especially for the most important trading partners, the president's going to be involved.
Okay, so the president's going to be involved. I think, like, look, at the end of the day, this is his baby. But you've got some smart people around him. Lutnick, okay. He's pretty smart. I mean, he ran a big bond house, and you don't get there from scratch without figuring out a few things along the way. And Bessent, I mean, you don't break the Bank of England without understanding how currencies work, shall we say. So I think, like, in the end, like, everything's going to be fine. But it doesn't change the fact that it's stressful in the interim, right? I get that, which is why, again, I just say, let us be a resource for you. You can swing $1 a month, okay? It's just $1 a month for the first 2 months, and then it goes to $9.95 a month, but it's worth it, right? Because you want to be sort of on top of all this, and I can promise you, we are totally authentic. It's my company I started with my friend, and he's worked on Wall Street for decades and run billions of dollars. And you know me, I've been on the front lines of all these financial crises, and I know a lot about how they play out and how the media, by the way, has a role in all this too. And selling begets more selling, and you get this pessimism, and it kind of feeds off each other. And then that's, I'm not discounting it, because I feel it too, guys. Like, I get it. It's stressful. And especially if you want to retire next year or in a couple of years, you're sitting here going, wait a second. And it's why it's very important as you get older, you want to look at portfolios if you're in the equity market, similar to what we have, say, in our income builder portfolio, because we're saying, hey, all right, you know what? You want to get some kind of dividend income in your older years, right? And the inflation protection is sort of a similar dividend play. And so those are opportunities within the equity markets to be a little bit more cautious. And I think that's important right now as we figure out just exactly where we're heading. Now, as I said, like, it will probably, I mean, hopefully, for goodness sakes, because I'm not about to bet against America. Oops, this is markets down. We got the wrong arrow, unfortunately, down on NVIDIA. And you may see some of this volatility here continue as we get sort of lumpy news coming out on these trade deals. And it's going to be a lot of news. So when you look at the VIX, do you guys know the fear index, the volatility index? Let me see where that one was today. Look, we had it at 60 shortly after Liberation Day came out. And that was a big deal. I mean, when you start seeing the VIX hanging out at 60, I'm comforted that it was only at 32 today. Still up 8% from the day before, but 32 on the CBOE volatility index is at least, not 60 or say 80 something like it was back in March 2020. All this stuff will eventually find its way of working out. But again, it doesn't change the concern in the near term. And I think that there's a lot of concern out there. So again, check me out at 76research.com. We have lots of notes coming your way, and it's important right now. It's important to understand what you're doing and what your future is as we watch all the political action going on. It's just like, I'll call it that.